how does a company actually put a number on a maybe? Think about a big lawsuit hanging over its head, or a public promise to go green. These costs aren't set in stone, but they are absolutely real risks to the business. Well, that's exactly where IAS 37 comes in. It's the official rulebook for dealing with uncertainty, and today, we're going to unpack it.
So, here's our game plan for this explainer. We'll start with the big question. How do you even account for the future? Then we'll meet the three key players, the main characters of the standard. After that, we'll dive into the super important recognition test, which is basically the gatekeeper between a real liability and a maybe. We'll look at what happens when something doesn't pass that test, apply it all to a really fascinating real-world climate example, and then wrap up with why all of this truly matters for a company's financial health.
All right, so here's the fundamental challenge, right? Financial statements are supposed to be a snapshot of where a company stands today. But what about those storm clouds gathering on the horizon? IAS 37 is designed to make sure companies are upfront about those future obligations, even when they can't circle the exact date or the exact dollar amount on the calendar just yet.
Let's kick things off with a classic scenario. Your company gets hit with a major lawsuit. Do you immediately have to record a liability on your balance sheet? You'd think it'd be a simple yes or no, but it's not. The answer is a classic, it depends. And what it depends on are the very specific rules we're about to get into.
Okay, so to manage all this uncertainty, IAS 37 gives us three main buckets to put things in. You can think of them as the three main characters in this whole story: provisions, contingent liabilities, and contingent assets. And trust me, understanding the difference between them is everything.
First up, we've got the provision. Think of this one as a definite liability. The company absolutely, positively owes something because of an event that has already happened. The only fuzzy parts are when they'll have to pay or exactly how much it's going to cost. But the obligation itself, that's a sure thing. And then we have the contingent liability. This is the maybe category. It might be a possible obligation that depends on something else happening in the future. Or it could even be a real present obligation that's just too uncertain to formally put on the books right now.
This slide really puts it all into perspective, side by side. A provision is real enough that it gets recognized right there on the balance sheet. It directly impacts the company's net worth. A contingent liability, on the other hand, is more of a heads up for investors. It stays off the balance sheet, but it has to be disclosed in the notes so that nobody's surprised down the line. So, how do you decide? What's the line in the sand that separates a provision from just a disclosure in the notes? Well, that brings us to the most important part of the standard, the recognition test from paragraph 14.
For any uncertainty to be recognized as a provision, it has to pass this really strict three-part test. First, there has to be a present obligation from something that already happened. This could be a legal contract, or what's called a constructive obligation, where a company's actions have created a valid expectation that they'll pay. Second, it has to be more likely than not that the company will have to cough up some cash or other resources. And third, you have to be able to make a reliable estimate of the cost. You need all three. It's an all-or-nothing deal.
Okay, enough theory. Let's make this real with a textbook example, literally from the standards guidance. A company sells its products with a 6-month warranty. They know from years of experience that some of those items are going to come back for repair. This is a perfect scenario to test our three criteria.
Now, here's where it gets interesting. How does a company come up with a reliable estimate? They don't have a crystal ball, but what they do have is data. So based on past experience, they figure 75% of their products will be perfectly fine, 20% will have minor defects costing $1 million, and 5% will have major defects costing $4 million. And this is how they land on a number. They use a statistical method called expected value, where they weigh each possible outcome by its probability. So 20% of 1 million is 200,000, and 5% of 4 million is another 200,000. You add those up, and bingo, you get a provision for 400,000. See? It's a reliable estimate even when the future is uncertain.
Okay, but what if an issue is even fuzzier? What happens when it fails that three-part test we just talked about? Well, it doesn't just vanish into thin air. Instead, it enters the world of disclosure.
So, if a potential obligation doesn't check all three boxes, maybe it isn't probable you'll have to pay, or you just can't estimate the cost reliably, it gets classified as a contingent liability. It stays off the balance sheet, but the company still has to describe the situation in the notes. This gives investors that critical heads up about risks that are lurking out there but haven't fully materialized yet. So what about the flip side?
What if a company might actually gain money, like from a lawsuit they expect to win? Well, those are called contingent assets. And IAS 37 is really conservative here. You are not allowed to recognize these potential gains until they are virtually certain. This prevents companies from booking income that might never actually show up.
All right, let's take everything we've just learned and apply it to a really modern and pretty complex issue. A recent IFRIC agenda decision looked at how IAS 37 applies to all these climate-related commitments companies are making. This is where the theory really hits the road. So picture this. A company makes this huge public statement. They've got a detailed plan, they've told the world about it. It sounds like a serious promise. But for an accountant, this creates a huge question. Does making this promise all on its own create a present obligation that needs to be recognized as a provision right now, the moment they announce it? This is exactly the kind of tough call that accountants have to grapple with. And the answer, maybe surprisingly, is no. In 20XO, when the statement is made, it's just a plan for the future. As the company invests in green tech over the years, those are just future operating costs. The key moment, the past obligating event, only happens in 20X9, when the company actually emits the greenhouse gases it promised to offset. It's that action that creates the real, present obligation.
And this right here, this is the absolute heart of IAS 37. You don't create a provision for a future choice or plan, you create it for a past action. The promise to clean up is about the future. The act of polluting, however, that's a past event that creates a present obligation to make it right.
Okay, so let's zoom out for a second and look at the big picture. Why do we even have this complicated set of rules? Why does IAS 37 matter so much in the grand scheme of financial reporting?
When you boil it all down, IAS 37 is a delicate balancing act. On one hand, it stops companies from just hiding potential liabilities off balance sheet and hoping no one notices. But on the other hand, it also prevents them from creating slush funds, basically over-provisioning for future costs to artificially smooth out their earnings. It's all about finding that sweet spot between being prudent and being transparent, so that investors get a true and fair picture of what's going on.
So if you're going to take away just a few things from this, let it be these. A provision is a real liability, just with some fuzzy details. That three-part test is the critical filter. A contingent liability is a maybe. It gets disclosed in the notes, not recognized on the balance sheet. And the most important rule of all, the obligating event has to have happened in the past, not be part of a future plan.
And that leaves us with a really interesting question for the future. We've seen how these rules apply to climate pledges. But what about new risks, like massive data breaches or the impact of AI? The line between a future business risk and a past obligating event is constantly being tested and redrawn. And how these fundamental accounting rules adapt to those new challenges is going to tell us a lot about what we truly hold companies accountable for. Thanks for joining me.